Investsense market commentary for the third week of June 2025. And we're going to do things a little bit differently this week. We had inspiration from, I don't know if you do the same, but you watch YouTube videos about whatever hobby you're interested in or whatever you might be buying at the time. And they have this annoying habit of telling you about everything and what they think and all their opinions, and then telling you, the punchline right at the end. And that's of course because they get paid for how long you watch that video. Us that actually for you it's completely the opposite, and maybe you want to decide up front whether you're interested or not. So we're going to call this What Then Why, which is a little bit similar to the what we're working on moniker that we use sometimes. And this is also convenient this week because actually we've got quite a lot to talk about in terms of what we're working on, 3 different subjects and just things that have come up with clients and things that have been occupying our mind, and of course the news. So getting straight into it, look, the market summary is that markets have been reasonably resilient. We all have these memories of the 70s and obviously it's terrible what's going on in the Middle East, and there's a lot of stuff in the news that worries people. And but does this really affect markets? Well, so far not that much. And is that just complacency, or is there some good reasons for that? And we'll delve into that a little bit more. But it seems like markets are able to look through this at the moment. And in the past, on average, that's been a sensible outlook. Look to the long term. And when we think about the long term, of course, we're going to talk a little bit about valuation, and we're going to finish off talking about some of the work, as we promised last week, that we've done around things like CBA, where we see pockets of value, but also where there is sort of still quite a lot of excess in markets, and CBA would be the poster child in the local market. So we'll talk about that in a little bit more detail. And then in the middle, an interesting anecdote that came from a query that we had from a client who wanted us to look at a particular set of ETFs investing in AI and quantum computing and things like that. And we think there's a sort of interesting reflection on markets that's fallen out of that. And of course, as we always like to say, if you do have any queries like that, please send them to us because there's always something interesting that falls out the bottom, and this is a very good case. And with all of these things, we've done quite a lot of work in the background, so if you are more interested and you want more detail, there's a few white papers and stuff like that, please just get in touch or talk to whoever you talk to normally on the distribution side. So look, straight into the markets. As you can see there, range of sort of, up 1% for gold and Japan. Australia's been remarkably steady, Eddie, in the middle, along with the UK. Now, those sort of cyclical sectors like global small caps and emerging markets have been off a couple of percent, as has Europe. But bond yields have been fairly stable, sort of staying around that sort of 4.5% level in the US, and in Australia a little bit below that, but really pretty stable. Currency, on the other hand, has been somewhat surprising. The US dollar actually weakened a little bit just before the weekend when we started to see Israel open hostilities on Iran. And normally you get more of a safe haven reaction. You saw that from gold. Gold was up a few percent. So there is a sense that there was a little bit of distress there, but it wasn't flowing into the dollar. And some people are talking about whether this is another sign that the US dollar as a safe haven is not quite so reliable. That's not how people are seeing it. But again, we don't read too much into it at the moment because there were fairly moderate moves overall. But of course, a lot of focus on the oil price, and we've shown this sort of 10-year chart to show that, look, it's a fairly dramatic increase in the last few weeks of 10-20%. But in the long scheme of things, it's not yet, we're not talking about the 70s. And one of the big difference between now and the 70s is while, energy is in short supply in some areas, and because of Ukraine and natural gas, etc., the main difference is the US is a major energy supplier, which is very different from the US. They were a net importer at the time, and elsewhere in the world, countries are trying to sort of wean themselves off fossil fuels at the same time. So there seems to be a little bit more resilience overall, certainly as far as energy prices are concerned. Not reasons for complacency, but this is an interesting chart that we came across during the week. Now, Obviously, we all stand on the shoulders of others, and this chart, I think, came via someone called Ryan Detrick, who got it from an organization called Carson, and we saw it in a newsletter that we subscribe to called ChartStorm. So rather than do it ourselves, we have stood on the shoulders of these various people, but especially this organization, Carson. Now, probably go to the summary, and what it's saying is when you average up all those geopolitical events, and we've got this table here which you might not be able to see, but I'll talk to it. Everything from the Second World War, the advent of the Second World War, to Yom Kippur, the Six-Day War, the 87 stock market crash, invasion of Kuwait, all these things going down through to Brexit, and then the most sort of recent example. And you can see, just if you just eyeball all that green and red, a lot more red in the first month, but then after 6 months, well, it's pretty much line ball. But the other thing you should zoom in on, if you wanted to pause this video and zoom in there, you can see that there is quite a lot of divergence. So some of the negative numbers after 12 months are very negative. 43% around the 70s. We had a few events there, oil embargo, Yom Kippur War, the Munich Olympics. They all kind of coalesced at roughly the same time, and you saw that sort of 40% type declines, also around the GFC, things like that. But there's also quite a few positive numbers in the 10, 20%. And then when you average all those things up, you can see there's two different averages here. Overall positive, but not very much so. On average, up by 3%. The median after 12 months up by 7%. But if you take out the Second World War, so you go from 1950 to now, you actually get some reasonably positive numbers, an average of 9% and a median of 10%, which if you think that on average markets have been up by sort of 6, 7, 8% per annum for the S&P 500, it's kind of in line, if anything, just slightly positive. So we wouldn't read too much into that. There's quite a wide divergence. But our belief certainly is that its valuation is where you get the resilience. So for instance, clients will be aware of our valuation dashboard where we look out to the long term and we say, well, if long-term expected returns are quite high, then probably those assets, there's a margin of safety, if you like, in sort of Warren Buffett and Ben Graham terms, and they're likely to be less volatile. Now, that's certainly what we've seen so far this year when we've seen the fallback in markets. And here we've got a chart just showing emerging markets, for instance, in bold, UK. We've also shown smaller companies, all with those higher expected returns, according to our methodology, and the US much lower. Hence, you get more volatility when you get more uncertainty. So we think that's the main game. But also, we do think it's worth keeping your eyes open and looking through the front window. And it was very interesting to see a little bit of a shout out from Trinetta Investment Management, who manage emerging markets, and very proactively on Friday they sent us through a sort of long piece which we've summarized here into a few bullet points. They've looked through each of their individual stocks and done what they call a pre-mortem on what an escalation in the Middle East would mean for their stocks. And basically there's a sort of principle scenario that probably those geopolitical risks are going to be constrained. But what are the vulnerabilities to oil prices? And obviously in emerging markets in the past, that's certainly been something to watch out for. And what kind of sort of sector effects could you see? Their focus is very much on domestic consumption. So, reasonably isolated from there. And probably the biggest risk they've highlighted, which I think a lot of people are writing about, is what if Iran basically put mines out in the Strait of Hormuz, and that would have an effect on global trade and energy prices as well. But their overall tone was not sanguine, but forewarned is forearmed, and probably not the end of the world at this stage. And that seems to be how markets are reading things. So also just talking about markets, we had this query from an advisor who uses some of our portfolios, and he had a client who has been reading about quantum computing, no doubt, and can see that this is the future, as undoubtedly it will be at some stage. So we did some research on that, actually quite a long white paper. I have to say AI assisted, it's very good at parsing this kind of data, and what falls out of that is actually, especially with quantum computing, to a lesser extent extent with AI, where we can see the changes happening and we can see how people are starting to commercialize that. With quantum computing, it's probably more like 10 years out before people can commercialize that. There's a lot of uncertainty. So in the absence of that, and we've got here the quantum ETF in the US, NASDAQ, and also the local listed AI infrastructure index. And you can see, well, this is the US version, and you can see how closely these things match. And that's probably one of the themes that we wanted to pick out. We did a whole lot of work on the underlying holdings of these ETFs. But the thing that really struck us, and it's really struck us about markets over the last 6 weeks or so, is how much they've traded in lockstep. And basically, what you're seeing is a lot of liquidity, a lot of sentiment. The fundamentals and the underlying stocks of these things, there's some crossover, but they're really very different. But as you can see from that chart, absolutely matching each other step by step. And that tells you that this is more about liquidity and flows and sentiment that's driving things, when some of the things that should be driving these stocks are sort of 10 years out and very different. AI versus quantum computing, for instance. And if we look at some of the locally listed comparators there, a very similar picture emerges. And basically, the punchline to this is not only the thematic point that we've made there, that liquidity and sentiment is driving stock prices. So some of these things look more like a trade than perhaps a sort of medium to long-term thematic play. Now that might change. So if you're looking at some of these ETFs, you might actually be saying, well, what I'm really playing is a bit of a trade, and where do I think sentiment's going to be in 6 months compared to the theme around AI or quantum or Mag 7, because those three lines would be very different if those things were in fact different. So then back to the sort of main point that we wanted to make and to finish on about what we're looking in. And this was something that we touched on last week, that we said we'd talk a little bit more about what's happening in the local market. And one of the main themes that we've been sort of toying with over the last few months is the need, in fact, over the last year or so actually, is as markets have got so polarized, is do we need to start doing some of our long-term valuation work, looking at individual risk premiums, not just at a region or even a country, but maybe at a sector or even just different baskets, Mag 7 versus the rest of the world, emerging markets, it's exporters versus domestic consumption. And in Australia, obviously, it's things like banks, materials, and the rest. And we have seen, quite a bit of divergence. So one of the things we're just going to, and we've been talking to clients about, we've got a new toy. This is something that we've bought in from UBS called Holt, and it allows us to do exactly what we do at an asset class level, but at a stock level, and then build up the same picture from a bottom-up perspective. Now, if we compare these two charts, we can see this is the sort of top-down asset allocation version, and if you zero on that orange line compared to the black one, and then you look at this chart here, you can see they look like exactly the same thing. And what they're saying here is that from a top-down perspective, emerging markets, very popular 10 years or so ago. They'd just done very well, and then they had a pretty moribund 10 years because the expected returns were very low. But coming out of the GFC, the US, on the other hand, expected returns were quite high because we just had the GFC. People had lost confidence in a lot of those big stocks in the US. They were mainly banks, for instance, but also Microsoft and Apple trading on high single-digit PEs. And now, in the era of US exceptionalism, the tables have turned, and there's very little confidence in emerging markets and a lot more confidence in the US, and therefore expected returns going forward for the US, because expectations are already so high, we think are a little bit lower, but in the rest of the world they're higher, and perhaps especially in emerging markets. Now, this line here that I'm showing you is exactly the same thing, but it's all the individual country companies, the assumptions around them built up, and you get a very simple picture. So if you know that, then you can start looking at individual. You can create your own baskets effectively, but you can even look at individual stocks in a very similar way. So here we have exactly the same chart, basically implied returns, implied yield in the UBS Holt language, and you can see we've got the same thing here with sort of almost zero expected return on this basis for CBA over the very long term. And basically what that's saying is if you take the current cash flows and you apply some sort of normalizing assumptions, well, at some point that thing's got to reset itself. If you think in terms of price earnings, for instance, if at some point in the future people expect a higher yield because they think CBA is an income stock, for instance, and they expect a say a 4% yield and something that's trading even in the high 20s rather than in the 30s, then that normalization process would actually give you a not very high long-term return. And part of the question now is, how do you get there? And this is a chart that we've shown you before. This is analyst recommendations. Normally they kind of split between reds and greens, buys and sells, with neutrals, that yellow one in the middle. But all the sell side analysts are very much in the sell side camp. And that white line compared to the yellow line up there is where all their individual models, what they think the current value is compared to the current share price. And there's a big gap. It's almost 50% now. So we can use this model to sort of parse that ourselves and then run different scenarios. Now, the important thing about this is we've run a very positive scenario. So we've said, look, what if we're wrong? Question what all these analysts think, the kind of maths that we've done, and say, well, first of all, we'll assume that it still trades on a fairly preferable PE. So that's that discount rate, a little bit technical. Ignore that for the moment. But we're saying, hey, look, it's all, let's just assume it's going to trade on a fairly high PE because there's confidence in the stock. And also that we're going to get back to that sort of post-GFC or pre and post-GFC period where Commonwealth Bank was enjoying fairly solid credit growth and a very buoyant economy because of the commodities boom and the knock-on impact on the economy, in turn coming out of China. So really back to the good old days. And if you had that kind of scenario on this basis, you would end up with still a 10% downside. It's very difficult to get to that. But also, the rub here is that that's a very implausible scenario. According to this model, less than a 3% chance of that happening. But more intuitively, given the amount of borrowing that's already happening in the economy and the macro backdrop, is it possible that we could see the domestic banks have those sort of return on equity of 20% or so and strong credit growth? Well, it seems unlikely. But even in that positive scenario, we're still seeing downside. And if we go to the more negative scenario, now again, the nuance that we've got here is this is not actually a housing recession or a crash. It's saying actually return on equity stays in the sort of low teens, which is really quite respectable. It's really just that at some point the price earnings ratio normalizes, and another way of putting that is that investors demand a higher return for the risk that they're taking. Now, there's no guarantee about when this might happen, but if you were to get any kind of normalization, then there's perhaps a sort of 60% downside. Now, if you were to have a strong recession on top of that, an increase in loan provisions, for instance, as well as that higher discount rate, well, that number could be even lower. So we think it's worth stepping out the way. Now, the main point that we want to make in relation to this is that CBA and its prominence in the index and the prominence of Australian equities within a local diversified portfolio means that actually we need to think about this almost like with the same emphasis as a country within international equities. It's almost the same allocation as, for instance, Japan, and banks as a proportion of overall exposure is probably the same as Europe and Japan and the rest of Asia all combined. So worth watching out for. And look, so that we don't leave it on too dour a note, there are other things going on. You take something like CSL. Now, these are not stock recommendations in the slightest, because what we're talking about is doing modeling on all of these things, putting them together. And when you've got diversified exposure to a whole lot of these sort of positive and negative influence and you're weighting relative to the index, then maybe you can bias things in your favor. So it's not about the individual stock. It's about the observation that there's a whole lot of stocks like this that are very out of favor. You take something like CSL, the darling of yesteryear, and analysts have exactly the opposite and they can't really work out why it's trading so low, less than sort of 50% of what a lot of people think its intrinsic value is. That's according to these sell-side analysts, and we've done the same sort of scenario analysis using that model with that and a whole lot of other stocks in that sort of mid-cap area. And you can see here, very similar story when you look at it at a stock level. Implied returns well below the healthcare sector, well below, which is the grey line, well below the rest of the market at the end of the teens, if you like, when it was sort of trading. And if we've got a PE here, if you're used to talking in those terms, PEs in the 40s and 50s, and basically growth, plugging along at 10 or 15%. Been very consistent for 10 or 15 years, and people felt not only was that going to continue into the future, but even with that growth, it was quite difficult to justify that valuation. But if you come to the here and now, people don't expect necessarily that growth, and even then you get sort of relatively high real returns of sort of 3 or 4%. You add inflation, that's 6% over the long term, and that looks a lot more attractive. You put a lot of those together and you end up with a better outcome perhaps than the index, which is very important in the Australian context where it's so concentrated. Which brings me to the active versus passive of this. Now, if you look here, this chart is something one of our analysts have put together, and you can see on average, most fund managers are seeing exactly the same thing as the sell-side analysts, and they're all underweight CBA, and we've got CSL overweight there, plus the other banks, because they don't want to be underweight at a sector level, so underweight CBA, overweight the other banks, and a few things like CSL, for instance. So the last thing I was just going to leave on, just to put this in the wide spectrum of time, you can see this is average returns. This is returns of the average manager relative to the index, and it looks like a sort of mean reverting series, if you like. It goes up above and below zero for a while. If you adjust for fees, which is that dotted line there, which used to be higher, I'm just stylizing this a little bit, then it kind of looks like it's reverting around zero. But you can see 94, the end of the 90s, into the dot-com era, into the GFC. Whenever markets sort of get to these more euphoric stages and you get this polarization, and if you look at the sectors weights, you can see that, for instance, by GFC, materials and banks were such a large element of the index. It was very polarized. You had similar dynamics at the end of the 90s. You had similar dynamics just before COVID. And these are the times when active fund managers tend to lean into that. And you can see on the plus side, when the market resets, they tend to do better. Now, we've had an extended period for a few years where managers seem to be leaning into this dynamic. And if you sort of extrapolate forward, there is every chance that you're going to see that bounce back at some point. Well, so the active managers that we speak to would seem to hope. So that's just a little bit of hope to finish on, and just trying to make the point that it's not all doom and gloom, and you can build resilient portfolios with positive expected returns, but sometimes you just have to take action and maybe do something and look out the front window. So sorry if that was a little bit more technical. I knew it would be, so that's why we create a little bit of room, calling it the what then why. There was quite a lot of a why, and maybe next week we can come up with a simplified client narrative of that. But in the meantime, hope that wasn't too boring, and look forward to talking next week. Thank you.